what is 100x? When a stock multiplies by 100 times, that's called 100x, 1 to 100. So what you need, to make this size of money, and we are not talking about in 100 years to make 100 times. We are talking about 10, 15, 17, less than definitely 20 years. The exact number is 100. 100 is not important. It's a concept. You have to think that you can make multiple times of it. So first you require is vision to see them, courage to buy them, but really most difficult at this point of time is the patience to hold. 100x doesn't happen at simple rate of interest. If you do simple rate of interest, like it will take forever to make it. It is because of the power of compounding. And I think when you're coming to stock market, I think this is the world of power of compounding. There is nothing happening in simple interest rate. So if you surrender a Maruti car, say 5 lakhs rupees today, you should be able to buy 26 Maruti cars after 20 years. That's the power of equity. So this is the list of the super growers, 47 of them. Mother of all the growth stock in India so far has been Infosys. The issuance was at 31.5 crores, got listed at 50 crores, and today it is 2 lakh crores. 15,000 crores is the total dividend. 25,000 crores waiting to be distributed. 12,000 crores annual profit. 4,000 times plus dividends. Then Lupin, I think this is a very surprise number that Lupin has made it to 1,200 times. And now it must be, if you count the last 6 months appreciation, maybe it is 2,000 times. Eicher Motors, 452 times. this is till March. Maybe it is 1,000 times now. This is stunning. Asian Paint is the poorest of all at 106 times. We'll get into the characteristics of these companies, but it is very important getting the hyper growth in your pocket. So what is the alchemy of SQGLP? There are million guys, million ways of looking at it, but this is our style of looking at it. And everybody will fall into this, they may call it differently. So size, I think one of the most distinguishing feature of all these 47 companies is that they're small to start with. Small, both in market cap and sales. They are very profitable companies, but very small and modest. But today, if you want to start, I would think that $500 million is a good number. So you can go up to 3,000 crores to start with. So first thing is it has to be small. Second, which is more important, it has to be relatively unknown. So you have to walk alone. Even if you tell any people, he's not going to appreciate because you only know the story. So it is good that you keep telling and nobody acknowledges that it is a good story, then it is a good story. So, I have seen it time and again. Nobody accepts it. That's why it is unknown. So you have to see that the growth potential here is the highest, and hence you must, with courage, you must allocate much more. And that's what really makes a difference in the wealth creation. So small and relatively unknown. The next is the quality of business, quality of management. You have to have high quality business. It is better to stay in the businesses where there are large profit pools, which is there today in India in IT, pharma, banking, consumer, maybe in oil and gas now. Quality of management, I think this is the most important one, more important than the business. The best business, best manager. How much money they can make, only time will tell. I think competence has to be highest, which in India you find all over. The guys are very, very competent. Integrity, you never find in India. It's the most rare commodity in India. So you have to find competence and integrity. And then third is, which is most important for this kind of companies, is growth mindset, the passion, the 24/7 urge to take the company forward. The growth has to be kept going, and growth has to be kept going not by the external forces, by the internal management forces. It is said by Phil Fisher in one of the books that 90% is management, 9% is business, everything else is 1%. Keep that ratio in mind. The growth is not only about sales growth. There is a sales growth itself is two parts: sales volume growth, sales realization growth. Nobody is focused onto the margin growth, and it is all multiplicative. Volume multiplied by price growth, unit price growth, multiplied by margin growth, multiplied by PE growth or valuation growth, whatever, price to book, price to earnings, whatever. So when you understand all four, then only you get the total growth. The confusion between quality and growth, one of the things I find, and I was not able to resolve for a very long time, is that all the great companies or great businesses, are they good investments? It makes great sense to stay with the quality but slow growth, particularly in this country where inflation is very high. But the real certified enduring multi-bagger or big growing happens on the top right. That is high quality, high growth. And if you can buy it at reasonable price, growth adjusted, I think you'll do very well. Longevity of the advantage is very important. You need to have the entry barriers or whatever advantage you have. And the long-lasting advantage. You have a brand, you have patent, you have low raw material cost, you have the scale, nobody can touch you. So that's what guarantees you continued profit for 10, 15, 20 years. Quality, growth, and longevity of goodness and longevity of growth. When all these 3-4 things come together, it becomes completely goofy for the market to figure out what is the right valuation. So we want to confuse the market by having the characteristics which market cannot fathom very, very easily. Price is the last. Because unless you have understood the entire spectrum of the real architecture of the company, you cannot value it. You got to buy a little more reasonably priced. So it lowers your total effort required to go to 100x big time. As it said that for human beings there is no substitute of love. For investing there is no substitute for paying right price.